I'm looking at some of the Australian data this week because if I'm right, and we're about to hit that interest rate situation, helping the morning Alpha team, PLANTY here. It's a new PLANTY. Look, the ears have been lowered. I've had some comments about the hair, quite rightly, and it's a fresh week, lots and lots to look at, and I do think this is one of those really important periods in financial markets on a yearly basis where you need to be really focused. I think the narrative is beginning to change, and we probably want to be looking to get involved. But we'll go through last week's data first, then a quick look at what's coming up, and then a few little chart ideas. So let's crack on. Obviously, going into the end of the week and over the weekend, it's been quite a sporting change. And sometimes we talk about the socioeconomics. People get interested in what's going on in the real world. Does it have any relation to markets? Probably not in this case, but it is the end of an era for Liverpool. Jurgen Klopp moving on. And then Djokovic got beaten last week on Friday, so he's not retained the record-breaking Aussie Australian Open. His conqueror Yannick Sinner, the youngster, he's won. I mean, on top of Luke Littler coming into the darts world, it's all out there. And then even England became the first country ever to win in India, having been behind more than 100 runs in the first innings, outspun them on a real spinner's wicket over there. So that was fantastic stuff to get us into the nuggets of the week. So last week, Bank of Canada finally dispelled all hopes of a rate rise, took the line out about rate hikes. They're in the next move down brigade now. People's Bank of China, they obviously got to work. We know that they're struggling. The required reserve ratio, the RRR, that's where they normally go to when they're not quite sure where they need to bail out. And by the sounds of it, they need to bail out everywhere. So that'll kick in. Releases 1 trillion yuan, Chinese yuan, which is about $139 billion when it comes in February. They're also talking about bailing out the stock market, probably because quite a lot of domestic punters play that. It's something that they've obviously lost a lot of money in. $6 trillion has been lost in China so far on the stock market since it started seriously pulling back. And obviously they need help. Bank of Japan, we started last week's preview talking all about what's going to happen in their meeting. Not a great deal, but they did still hint towards having to look at embedded wages in the economy. And that actual wage negotiation we've been talking about, it's called the Shunto, businesses and unions negotiating. That's started, and we're expecting that result in March. ECB, they had their meeting, still in pushback mode. Lagarde telling everyone how great she is and how poor everyone else is. No one's really believing that they're going to wait till June. The data isn't really that strong. They're hanging on. They've got some GDP coming out this week, which we'll talk about. No, nothing's going gangbusters over there. The market is starting to tell them it's a 40% chance of April. They had German IFO out. That is the industrial survey. I think I've mentioned it before. That's more relevant for business activity rather than the ZEW, which is financial intermediaries talking about on their views. Outside that, Cube, a quite shrewd hedge fund, they announced that they're putting on even bigger shorts, selling Volkswagen, Deutsche Bank, and various other things. Germany struggles when China struggles. But overall, inflation surely is out of the way. The German bond market's telling you that long-term rates are at 2%. It's getting very close to them having to do something. But in that, they're not alone. Bank of England, they had mixed data. The PMIs, I mentioned it on Friday's live show, starting to show some signs of the Houthi crisis adding to prices. Not surprisingly, they're having to go around Africa to get the tankers and stuff over to UK. But the UK confidence data, that was a lot better on Friday, despite the fact that it's been running negatively for well over a year. I've talked before about the apathy in the UK markets. People just, totally bashed down. But the personal finance outlook became not negative. It was in at zero, but that's the first non-negative for ages. People much more likely to make bigger purchases down the line, and hopefully that lines up with interest rates coming off, mortgage availability, releasing some, tied up money. And then the Fed, they're in holding period because they've got the meeting this week. their S&P Global PMIs, which have a slightly different percentage set up for the components than ISM, and ISM comes out this week. They were slightly stronger, showing another slight pushback on rate cuts. Idea was the way the market read it. GDP again off after retail sales figures that were strong. I saw that nudged up. I saw some expectations, 2.4% for a quarter. So the advanced print came out, and that was at 3.3 quarter on quarter. So people getting all excited about that. But inside the detail to that, there's the nominal GDP, and that's before inflation's in there to take account and give it a real GDP number. But nominal, sometimes it's worth going back to look at, because I was listening to some quite clever people over the weekend who are saying everything's bobbing along nicely, but it doesn't take a lot historically. If you look back at the crises and recessions, everything looked fantastic until it's not. And within that, the previous quarter's GDP was running at 8% nominal, and then this figure is down to 4%. So obviously this is pre adjustments for inflation. GDP is activity times by price, effectively, and all we're seeing is decent activity numbers. So that tells you if that total is falling, it must be due to prices. That's what we'd expect. We've seen inflation come back, but it's come back 8% to 4%. All of a sudden, if you're not careful, you'll have that declining or going flatline. That's when you get a recession. So I'd imagine that they're now talking at least about that. It's not what you'll see every day on the shows, but it's in there in the background. And I'll keep going on about this deflation in the system in China and disinflation across the world as all the central banks slam the brakes on. If you don't get a move on here, it'll suddenly be having to chase it. So I mentioned a short while ago, ECB talking about the market's talking about April, and yet we're still arguing about whether it's March for the Fed. There's no way. And also, I think in the background, I've heard that the Bank of England expectation of the market is for May, not June, or certainly building towards that. So do we really think the Fed will be the last to move in that situation? I don't think so. They want to keep control. So we're in a week here where they may not actually make the rate cut this week, but I think there's reasons why, as we'll show, that they might change the narrative and say, push the market towards something happening to normalize in March. So a couple of key things I'll be talking about this week is we've been talking about whenever they have the services inflation print, rents are very sticky and not moving anywhere. But the Cleveland Fed have actually looked at that, and there's a criticism that because those rents are an aggregate basis, including all contracts in existence, the rate of change isn't really measuring what's going on. So they've done a survey looking at what happens on a monthly basis, and they've actually shown that to be falling 0.5%, I think it was, or if not more. So there is services disinflation coming, and it may be in the next print. Favorites PC, the Fed's favorite, the PCE on Friday. That, as expected, the headline no longer has a 3 handle on it, and the underlying is running closer to 2. So everything is there. I've mentioned it. They've got the reasons in the background to be able to press go, and they don't want to be seen to be what they call passively tightening. They're already at super tight level, and let's look. The way of looking at it is that tight policy was appropriate when inflation was going gangbusters, and what we've got now is something completely opposite, and if not, starting to look like disinflation. If we're not very careful, it's disinflation. It might get even worse. So they need to change that. They need to normalize it. They need to get crack on. And I'm leaning towards the next couple of weeks. We've been talking about how the dollar's setting up for a sell-off. I think there's going to be a rate cut in March, and certainly signalled that way. But they can put, so that people don't get crazy, they can change a commentary that goes with that. They can change a dot plot. But I do think they need to start the path for normalization. If anything, you could say that the unemployment data is worse than it looks. There's technicals. I mentioned it in the very first one. It's all about the participation rate being the divider. And there's a lot of people who are deliberately not joining the system. They probably think they can't get a job. All we're seeing is major job cut announcements. The only pushback I'm hearing is this embarrassment factor of if they go now and inflation comes back, they have to put rates up again. Well, hey ho, that's the job, isn't it? Get on with it. There's going to be a lot of pressure at the end of the year. I've said we're going to get the major moves in the first 6 months, I think, this year, and then you've got obviously elections, fiscal funding. You might see inflation pickups in the data. Geopolitics is already escalating. Excuse me while I die over here. And again, the Fed, the local Fed, Federal Reserve banks have been doing a lot of work themselves. The Atlanta Fed had a paper out this week talking about the last mile not being so arduous. So why do you make it so with tight policy? And I think that's what really started the debate about March becoming serious again. The market really seized on those two prints, the Cleveland and the Fed papers. I was listening to a podcast at the weekend. They're saying that the Fed's PCE, their favourite measure, their forecast managed to miss that by 100 basis points in mid-year. So they're behind the curve on their own forecast relative to what's happening. And similar things have certainly happened at the Bank of England, and they'll be trying to correct that this week. So net, focus time, get ready. This is a week where we have to be watching. There's lots going on, lots of earnings, and so much data. I've picked out some of the main bits, which we'll look at in a minute, but it's such a busy week. So the main narrative that's out there, again, I've mentioned it, it started the year in place, this party like it's 1995, and some people have, put that back to the original lyrics of party like it's 1999. We're somewhere rhyming. Remember, things don't repeat, but they rhyme, and the setups are certainly like Greenspan taking the rates off in 95, or is this more like people trying to say it's more like his put in 97, 98 for LTCM and irrational exuberance? But they're all forgetting that all those things happen, and if it's similar, we still haven't had the melt up. Things are well advanced from last year's, from the October 22 low, but I wouldn't say that they've got ridiculous yet. And if anything, as we'll show with the charts, it looks like we're into extension zone, which means there will be pullbacks. There's always pullbacks, consolidations, but they're likely to be small. So I'm leaning towards it being by the dips scheme again. People really do have to sharpen the pencils and get involved on that. In terms of stocks, Eurotech was where it was at the start of the week. ASML, a big win. ST Micro missed. So it's been all over the place. Global tech, TSMC started it off and really upbeat message. But then Intel, they blew it, massive miss. To me, it feels like that's an overall guard change. Are Intel really placed in the right area? Their chips aren't necessarily the AI ones like NVIDIA. So net, it's okay. First of the Mag 7 came in, Tesla, with Elon in his parallel universe, not really giving guidance. Market always wants guidance in Tesla. So that was a poor start to the Mag 7, but the markets looked through it. And you probably saw Microsoft became the second company to go through 3 trillion market cap during the week after Apple had done it previously. There's some pushback, as I said on the live show, that it's possibly the new Cisco, but these guys are actually monetizing. And Cisco, which was all about routers, in the end, that worked. It was just that was, again, people talking about a period right at the top in the 2000s. We still haven't had the complete and utter nutter melt up like we had back then. And as I put on my preview, if generative AI is so cognitive and with it, then surely that's going to create headlines and a scenario that doesn't stop it getting its funding so that it can develop. So watch out for AI taking over the narrative. Geopolitics is always going to be tricky. Friday night, the tanker got hit. Sunday night, Iranian-backed rebels hit one of the US bases. That's really accelerated things, and it's put a bid under oil and gold again. Something that I picked up during the week was India, who are trying to stay neutral, are in the Red Sea, mainly because they're wanting to keep an eye on the Chinese ships that keep docking in places and doing spying missions. But they can tell they don't want their trade channel shut off either. They're acting as first responder. But the fact that people who are neutral are in these areas, it doesn't take much of an error to draw people in. They didn't expect that's how major conflicts happen in history. Hopefully this all sorts itself out, but it's going to be at the forefront of everyone's mind. Remember, I mentioned it previously, that Citigroup survey of their investors. What's the most worrying factor for your investment outlook this year? And geopolitics came in at the top, and it already has started right up there. So last week, oil, we had a look at it last week, and we did get a little breakout to the top of the channel. We'll have a look at that in a bit. 6.5% on the week, not bad. We've got the OPEC meeting this week where nothing's expected to happen. It's not really a meeting that does have action, but it's all about the messaging as usual. And gold, I said, can I leave it alone? There's a new setup. You'll have seen it if you were watching on Friday, but it's in the preview. So here we are, week the 29th of January, week commencing. What is coming up? So it's more like, as I've said there, it's more like what isn't coming out this week. Absolutely bonkers. Japanese unemployment figures on Monday night before their Tuesday session. With all these Asian things, Japanese particularly, we want to see tightness. We want to see them any signs that they're getting that inflation, and that will get the yen going. Then they have retail sales on Tuesday as well. We want to see that rampant if we can. Various Eurozone figures, GDP and CPI, Eurozone consumer confidence, home prices in the US, JOLTS. That's the first data of it's employment week in the States. JOLTS first up on the Tuesday. We'll look at that in a minute. The dollar sell-off we've been looking at, then commodities are going to be in focus, and obviously Aussie dollar, US dollar is the way to play that, and that does look like it's at the very bottom of a 5-wave move to finish the consolidation, which could be quite steep. So we'll look at the chart on that. Chinese data, I think it's too early to see any rebound from the bailouts, but people will be looking. It's very difficult to get anything to compare in China, so it'd be nice to have something on the tape. Germany and France have a lot of data coming out. They got Wednesday, the old ADP and employment cost index, more on the employment side. Thursday, the Bank of England, more Chinese PMIs, European PMIs, and I mentioned it earlier, the ISM manufacturing. Let's see how that looks relative to the globals that came out last week. So we should see strength. Everyone's ready for strength. And remember, Tim Fiore last month told us that he thought his clients were telling him that goods inflation, disinflation was over, and that was likely to come through. So far, that's not happened in the global PMIs, but the ISM is the daddy boy. And then Friday, stand by your beds. It's US jobs report. So detail-wise, ECB, what's happening there? Flash releases of GDP. As I said, it's expected to be negative, small negative. The thing's flat overall. Germany's rubbish. One or two of the other countries are holding it up. I'd be amazed if there's anything to turn the dial there. CPI, equally, the headlines have been struggling because of the read-through from energy prices. That's beginning to fall off. Some think there'll be some favourable services inflation. And if so, that gets back on the consensus is June now for a cut, but the market's saying April. Is there anything to put that off? The Fed, massive. That's what I'm saying. Everything about the Fed this week is huge. Obviously, the meeting, the announcement Wednesday night, rates won't get changed this time, I don't think. No one on the planet is expecting that, so that really would be a proper change. Guidance for the cuts is still 75 by them to maybe 100 on the outside. Look at a dot plot with it starting in Q2 versus a big move in the market, and me especially. I'm looking for language shifts, dot plot changes, the works. Look out, Wednesday's big. And it also has this other thing, which you can see there, US Treasury quarterly funding announcement. So when that came out in November, I think it was either the same day or the day after the CPI had given us some disinflation positives. I thought that actually was more important because they've got a slew of funding to come out at the end of the year. We know that the deficit is runaway massive, but they actually said that to take the pressure off the long end, they were going to unexpectedly issue a lot at the shorter end, and that was responsible for at least half of the decrease in US yields when that happened. So it's important people will be watching it this time. So make sure we are. I'll try and keep an eye on it. But again, that all falls into the mix of what's happening with quantitative tightening, QT, or is it QR reversing? Basically, we want to see as little pressure on those yields as we can. So those two, the major moves. I mentioned Jolts is coming out. That's still moderating. The key trend last year was people doing two jobs or quitting jobs to take a higher paid one. Looks like that's starting to fade, and the Fed do watch Jolts, so keep an eye on that. ISM manufacturing PMI Thursday this week. Soon they'll get back to their old Monday, Wednesdays, but it's strange with the way that the winter fell, Christmas fell. So global PMIs went into positive territory. Highly likely ISM follows it, and it's all about prices, as I've said. US jobs report on Friday last month. I said the whisper number was higher, and we got the crazy breakout number this month. We're expecting 162 as consensus for the minute. We'll try and find the whisper number as the week goes on. The range is anywhere between 140 to 85, and the unemployment rate expected to be unchanged. Average hourly earnings we need to look at for the read through to inflation. But the key thing about this month is it gets an annual revision factor put in. So every month, as well as the headlines, you want to listen out for what the revisions. The previous months get changed, and often that can be more important than the actual headline. Well, this is the sort of aggregate for the year. They do a one-off rebasing to tell you what the 23 total number really was. Shouldn't have anything to move the dial, but it's expected at 306,000. We'll keep an eye on that. Bank of England Thursday. So lots happened for them, and I've said they've always had the trickiest job, but it's certainly not as tricky as they made out in November when they were saying they didn't expect inflation to get back to their levels until 2025. What's likely to happen now is that they change that narrative and say they expect a bit of normalization in Q2 this year, and they'll start changing rates. May still remains June still remains the most likely according to the market data, but people have started pricing in May. So that would give us kind of April, May for ECB and Bank of England. Fed surely is March. I've mentioned China. Australia, they're not expected to change rates, so I don't expect retail sales or CPI to move that dial, but keep an eye on it. That might just be something else that puts a bid under the Aussie dollar. Oil, I mentioned the meeting. It's called the JMMC, which is the Joint Ministerial Monitoring Committee. Meets every 2 months, bi-monthly. So it's the OPEC plus the OPEC Pact, which includes Russia. They normally do it online. They won't be doing any policy, but there was a rumor last week saying that there definitely won't be any changes. There won't be any commentary from some unnamed sources, so don't expect a lot to happen. The biggest thing that anyone to do that has had anything to say was that Davos, the Saudi Aramco guy, said the previous forecast had been 2.2 million barrels per day for 24, and then 1.8 million in 2025. So demand destruction, which we spoke about last week, is so severe. It's only running at 1.5 million so far this year versus 2.2. That is that underlying demand weakness I talked about, just at the same time as you've got high global supply. So oil should still be in a downtrend, but we've got some lovely bullish ranges happening at the moment. Earnings, so many, and really does it matter because the Mag 5 of the Magnificent 7 are with us this week. That is starting with Microsoft and Google, or Alphabet as it's known now, on on Tuesday. And then the 1st of February comes in with a bang. You've got Amazon, Apple, and Meta. The narrative's all going to be around them. Can anything else out there matter? If it does, we'll try and mention it as the week progresses. So charts time. What I want to look at is obviously our first starting point is the dollar. We looked at it on Friday. Midweek, it looked like it was taking out the previous low to perhaps have put in the top. And I suggested that there might still be a little bit of to and fro in sideways before it finally comes off. And it does look like there's a bit of nesting, and last week's high is obviously the resistance. We'll look at that in a minute. Then we've got Aussie. Bye. They're brilliant. I don't know if you ever get a chance to go and watch the Aussie cricket team abroad. Their fans are absolute nutters, and they're great to get involved with. Buy the dip scheme, as I said earlier, we're really building up for that. Don't get short and caught. I don't feel like, unless you've got some compelling intraday setup, that you really want to be shorting any of the US indices unless you're doing it on a short-term basis. I think you could easily get whipsawed and quite nastily, so be very careful. Gold and silver are both in triangles. I'll show you the gold triangle, and we'll have a look at the little oil breakout. So here we have the US dollar index, and it looks very interesting just because of the whole move down that started over here, and we're doing this wave 2. The retracement of wave 2 relative to that wave 1. Last week's high sat at the green line there, which is a 50% Fibonacci retracement. So that's a reasonable level to have stopped. If we go into the actual move itself, relative to the first wave of this 5-wave move, the 5th wave stopped at 1.618. So that's a normal classic fib place to stop. And then the overall move of 1 and 3 versus 5, that's set at a 50% fib. So it does look like it's a quite significant and important level, and so far it's not been broken. So here, we've had what looks like a first impulse down, a 3-wave retracement that failed to take out the high, and then are we in a nesting down situation? So 103.81, 7 on the DXY. That's a key level to see whether we're actually come in here and there's always a chance of doing a double correction up to those original highs before we sell off. Or I've been saying for weeks, we're running out of time. Data heavy week, concentrated in the right areas. Looks very much like we could get the dollar sell-off. Geopolitics trying to get in the way, but net, it's going to be run by the markets and the interest rates. So I've been looking at a couple of the US indices. And let's look at the S&P 500 to start with. So we were looking at this channel last week, and I said we were breaking out, and a lot of the indices were making new highs. Everyone's saying it's topping out, but what they were importantly doing was breaking the structure of and breaking the wave rules. So it very much looked like we're starting to nest again to the upside. So ordinarily you'd be looking for a pullback into the channel, and we may get that, and that's probably going to be, you often get that as a false signal. It comes back in and then shoots off. But yeah, we'll keep an eye on it. We'll start looking at gradient changes in the next few updates, because it looks very much like we're in a 5-wave move up here, and we're only at the start of the 3rd. Looking at the intra-wave relationships, wave 1 here, setting up there for mirroring itself in wave 3. It's already reached a 1-for-1 tense. We may get a little pullback there, but we're looking for these to break out. So we want the overall wave 3 move to be in the sort of 1.618, 2.618 kind of area, because it's the impulsive part, the 3rd wave within a 3rd wave. You wouldn't expect them to stop around a 1-for-1 level normally. That's what we're looking for in consolidation. So stand by, looking out for those, and then if we're measuring the overall moves from the bottom of the second intermediate to this first breakout wave, then the 1.618 of that takes us up to 57.69. There's some serious potential for short-term moves, and if you're selling these short-term consolidations, the 2nd wave and the 4th wave, very good chance you get whipsawed. Lots and lots of market moving data and earnings out there. Nasdaq, that's pretty similar. I was looking at this one yesterday. Lots and lots of Fibonacci key levels lining up. We had that big level invalidation here, so we had to redraw everything. That was the 1-for-1. So again, if that is, we're looking at on the 1-for-1 basis, we want to be looking at the 1.618 as the first stopping point, maybe for the current 3rd wave, and then that's another 3rd within a 3rd. So this is why I'm getting excited, because the we're in impulsive waves if we've got this right. So everyone's looking to sell it, and we're actually going to get dragged higher. And you're always looking for thirds of thirds. That's where all the action happens. And then looking back to what the overall 3rd would be relative to this first blue wave up, then that sits up here at 19,061 kind of level. 2.618 is up here. A 1-for-1 of the whole first wave up for the 3rd wave, where we're we'd like to see that putting a new high there, so that tells us we've got even more growth on the uptrend to come. Obviously, you get a pullback, but the way that this thing is nesting and going up so quickly with short pullbacks means that when we get the first serious pullback after this full 5 waves, 5 blue, 5 primary blacks you can see here, then the previous lower degree becomes important, because the fourth waves, and a lot of them are lining up here, that becomes this channel in here, the blue channel around 18,000. Once we take that out and we go to new highs, that's going to be the defensive level. That's going to be the support channel. So we'll look at that as it progresses, but it does look interesting. We talked about the Aussie dollar. Let's just look at that. Yeah, so I've got the daily set up here. Hopefully the weekly doesn't mess it up too much. I'll stick with the daily dollar. We'll go into depth on one of the updates that we do. So basically, it's in a downtrend. It's put in a long-term one in October 22. We're since in what looks like an ABC correction, of which that could get quite interesting. We've had the first leg. We pulled down to a B, and it very much looks like we're in the first nesting situation. A 1 and a 2 have happened. We're about to have the major part of the move there. So based on the first wave up from the B low, 1 for 1 takes us up to spot 712, but we're looking for this to be an impulsive move. 1 spot 618, level is 0.744883. So I think we've got potential for a serious move here with the Aussie dollar dynamics. In the first instance, though, if you want to just put on a short-term trade, for this whole thing to be, for us to be confident that this is all happening, then we want to see a new high. So what I mean by that is the movement from the B low was already put in the first one. We want to see that wave 1 taken out. So an initial trade we could look at is versus what we're calling a 2 for the moment. It gives us a decent idea of a stop loss. If we buy in today, then we've got quite a good risk reward ratio. 6.3 currently set out up to date. So we've had a little bit of a rally in Aussie already. Then 6.63 just to take us up here to prove that we're in a high environment. And then, we're actually looking for much bigger moves up here to spot 748. So let's have that as a first idea, and we'll deal with it as it comes on. Tightish stop loss, but, events could take over. There might be a bigger delay than what I was expecting. But net, if we are getting into the bullish environment, get on board. Aussie dollar is the way to play it, I think. Be careful with some of the other pairs. Aussie yen, for instance, at the moment, you're negating the dollar both ways in that trade, so it becomes a relative play of Aussie and Japanese yen versus the dollar. And a lot of these pairs at the moment are going to be like that. So you need to watch out for doubling up your bets versus the dollar, etc., etc. But really, we're looking here for the minor risk on exposure that wins both ways. So Aussie. We've got gold, haven't we? Let's have a look at that. So the gold boy, we talked at length about all the setups. We're still bullish until 1973 gets taken out. We're still bullish really unless 2000 gets taken out. It's been defended heavily, large volume. We mentioned it. Look at all the volume spikes. So another way of looking at the pullback from the wave 3 top at the all-time high in December, the 4th session, is that what we originally thought could be an ABC. It takes us down to 1920. It may well be a triangle. And remember, we're in a 4th wave. So wave theory and Elliott wave theory are massive on the look back and the interpretation and the guidelines that have been produced. triangles generally take place in choppy sideways consolidating trading, which is what you'd get in a fourth wave. And if you do get a triangle here, which is an absolute battle, which is what it's felt like in gold, everyone's saying they're struggling to win. Every time you're going up, you get reversed. That's a proper setup for, a two-way pull, but with the bias of the underlying trend, which is to the upside. Remember, we're in a fifth wave of a multi-decade bull market. And what also happens, I talked about commodities extending their fifth wave, keep on going and going, do most of their work there. Now, historically, in the charting history of Elliott Wave, if you get a triangle in the fourth wave of a move, then that sets up, particularly in commodities, an extension. So the stars are aligning, and we've been weaving our way through this. You put in the trend lines from the bottom of A and the top of B through the next interesting levels, and we've already put in the C on the 17th of January, so that is setting us up, weaving away around here, low 2030s back down to 2016s, where we've had an overnight move. You can see actually got live price here on gold 2032. It's helping the pension. Woo woo, keep it coming. We potentially could get a breakout of this channel today, so we might have to reinterpret. We might already have had all of this, but equally, what normally happens is it's when it's hit the lower trend line, often overthrows to spook people into thinking it's over, and then gets a whipsaw, a hook, and goes mental. So there's every chance that gold runs out of steam short term, but it's very easy also to put in the fact we're in that 1-2 alternative nesting situation. So any kind of valid three wave, and we've had an A, B, C here, because that C low hasn't been taken out and it shouldn't be in a triangle, that still keeps the nesting to the upside valid. This could easily go banzai and go to the all-time high from here. And if it happens to be that a combination of geopolitics and the Fed moving the narrative this week, that could be the cocktail we've been waiting for. So again, this is one not really too short. You're looking to buy the dips, stay with the trend, don't fight it. And then finally, we've got our old buddy oil. I'll just quickly go through the two setups we had. So I remember we said the overall trend is down WXY. At the moment, we're putting in a lower level WXY. We'll relabel this properly, but it's still an ABC down. And the move to last week's high is a W. It could keep going all by itself, but what we'd really expect is to have a little three-wave pullback at the lower degree to put in an X wave, and then have an equal legs Y to finally put in the top of the B. The geopolitics has happened. I said it should have been in the 80s, if not up to 100, given everything that's been going on. But you've got that overlying supply issue, just dampening it all down. It's fighting well, and I think we should allow for this setup until something sorts itself out in the geopolitics arena. I think the mood music is being changed. People are taking notice, and I said it's geopolitics was the top pick for worries. So just going in at that lower hourly level where we looked at the setup last week. We talked about the range. We're in the middle of the range last week. We said could easily go either way. It has been doing. We need a bit of a clearer path, but it's come in and it's completed what we did have in here. The 1-for-1 level was 77.67. It's taken that out, moved a little bit higher, and then we're starting to retrace already. If you can see that there, a little bit of tension coming off. What we'd like to see is a little, if it's not completely the pullback, we're expecting the three-wave back into the channel and then potentially going. It's one of those where it's nice to know what's going on, but we shouldn't really be playing it. It's hard conviction to know what's going on. The underlying trend is down, so buying for geopolitical events is obviously dangerous. If anything, it's looking a little bit strained short term. If you have to play it, it's probably a three-wave, but consolidating three waves, just as a general point, you don't really want to be messing around in the middle of the structure. You're looking for the end of it, the turning point. That's where we can measure it. Once we've got the first leg down, we can get our 1-for-1 in there to give us a bit of a guidance. outside that, we don't have to be playing every instrument, but it's good to know the underlying and what the read-throughs are. So hopefully that's helpful. Good review of last week. The setups. Come on, the mighty England. Buy the dip scheme. Come on, it's time to get all aboard, all aboard. We want to be involved in this. Be very careful with your shorts. Keep an eye on the data this week. There's lots and lots moving the market. Oops. And, you know, it's going to take us to new highs on some of the instruments. So, you know, time to be positive. Get the positivity out there. Accentuate the positive. Don't listen to the doom mongers. And this is one of the important 2 weeks of the year. Stay involved. Be careful out there.